Good evening, everyone. I'm a bit later today. Let's continue reviewing the performance of the three major indexes. To be honest, today's move was somewhat unexpected. It was clearly a good news priced in type of session. We can see that the Nasdaq, after yesterday's gap up open and an upward push, formed what's commonly called a gap and crap pattern today. That's generally a warning sign. Yesterday, we mentioned lowering the medium-term alert level for the market from level 3 to level 2. Today, it may need to go back to level 3. Yesterday, we also discussed a simple method, dividing the consolidation range into weak, neutral, and strong zones. Today, price fluctuated within the neutral zone. We know that yesterday, Nvidia reported very strong earnings. But honestly, starting last night, I already had some concerns. Not that the report was fabricated, we won't say that, but it felt somewhat like a confidence boost delivered at a moment when the market desperately needed one. It's like serving a cake when everyone is hungry for reassurance. But once the cake is eaten, if there's no next cake, the market may struggle to sustain momentum. Now looking at iShares Expanded Tech Software Sector ETF, IGV, which tracks software stocks, on the 4-hour chart, we can see it has already started a rebound from the lows. What's driving that? Previously, Anthropic released a tool suite designed to empower software enterprises. At the same time, a representative software company like Salesforce delivered a very strong earnings report yesterday. Their results were closely integrated with AI. In other words, they are a traditional software company that incorporated AI and actually improved performance significantly. So the market is seeing signs that software companies may not be disrupted as quickly as feared, and may even benefit from AI adoption with potentially stronger earnings going forward. However, in my view, this could be a short-term spark rather than a structural shift. The broader market may simply be seizing on this theme for rotation, capital temporarily reallocating into a hot sector. We can see that Nvidia had very large intraday volatility today, but despite the wide swings, price is still within the ascending channel we drew. There is still significant room for a pullback, even down toward around $173. From the current $184 level down to roughly $173 would still be considered a normal adjustment within the channel. So we cannot simply say that the earnings were too strong, that the good news is fully priced in, and therefore investors are dumping the stock. That conclusion is premature. Today's data shows that some institutions were indeed selling, but retail buying increased significantly. 10 years ago, retail investors did not have the same access to information as institutions. But now, with AI tools and the widespread reach of independent media, retail flow data carries meaningful reference value. So we cannot immediately conclude that Nvidia's positive catalyst has been exhausted and that it's time to start shorting. Not yet, because price remains inside the rising channel. Now, returning to the index. On the 30-minute chart, we can see a technically unattractive pattern. After a gap up open, it quickly formed a gap down at high levels, creating what looks like a dark cloud formation. That kind of structure places pressure on the market. If we zoom out to the 4-hour chart, price may continue to fluctuate within the neutral zone for some time, likely 3 to 4 trading sessions battling within this middle range. That's the situation for the Nasdaq. As for the Dow today, it actually narrowed its losses into the close. That reflects a degree of defensive positioning, a risk-off mindset. There's growing uncertainty about whether the AI bubble, led by semiconductor stocks, could weaken. Capital may rotate from the selling shovels companies, the infrastructure and chip providers, toward the companies that actually use the shovels, such as Salesforce. Investors may also begin to focus more on the profitability of AI applications. During this capital rotation, defensive positioning is understandable. Regarding the Dow Jones, in my view, it continues to maintain a very clean consolidation channel. If we ignore the brief breakout above 50,000, the broader channel structure remains intact and well-defined. It has stayed within this channel consistently, and it's even beginning to show slight convergence. Under these conditions, if fundamentals do not change significantly, this healthy trend could persist for quite some time. We cannot conclude that it will immediately break out or set a new high above 50,000. That's not the point. The key is that it may continue trending within this channel for an extended period. So that are index parts. Now let's move on to individual stocks. Today, we'll mainly review the 2 stocks we previously recommended. The first is Circle, which we highlighted yesterday. Its performance today remained very strong. Yesterday, we showed that Circle had returned to its prior price midpoint, which is a powerful reversal signal. After that reversal, it continued with 4 consecutive bullish candles on the 4-hour chart, a very strong continuation signal, accompanied by a surge in trading volume. That signal was extremely clear. Those who entered yesterday likely captured solid gains. We will continue monitoring this stock. It remains in a strong zone. For those already holding, maintaining the position is reasonable. For those who have not entered, as long as price stays within this range or pulls back without breaking below the range, it can still be considered a buying opportunity. The second stock we recommended earlier is Vertiv, which focuses on industrial liquid cooling. We have discussed its fundamentals many times. Data centers require liquid cooling, and until space-based data centers become operational, this demand will not change. From earnings performance, fundamental strength, and long-term industry prospects, data center construction remains a stable and expanding theme. We recommended Vertiv before its gap-up move, and it continues to show strong upward momentum. The suggestion here remains simple: continue holding. Regarding Micron Technology, there has not been significant change. It is still consolidating at high levels. In my view, this represents a strong corrective phase rather than a breakdown. It is not yet the time for panic selling. Although the memory industry has cyclical characteristics, major manufacturers are increasing hardware procurement this year, which supports earnings expectations. Micron remains within a strong range, and the most explosive upward phase may not have arrived yet. Investors with positions can continue holding. However, for those with lower risk tolerance, this may not be an ideal time to initiate a new position. Overall, the stocks we have recommended have performed well, despite a choppy broader market, delivering solid returns. Continue following our channel daily for updates. As always, if there are specific stocks you would like covered, or if you have questions about US equities or global investment strategies, leave a comment below. Your feedback drives our content. That concludes today's discussion. Please subscribe and follow, and we will see you tomorrow.